Welcome back to the deep dive, where we smash the black box of complexity so you don't have to.
And today, that black box is group insurance.
Right. If you have group benefits through work health, dental, disability, you know that premium is a big line item. But the mechanics behind it, why it costs what it costs, or why a specific claim gets denied, it often feels completely opaque. A total guessing game.
It feels like that because, well, it's deeply complex. Our mission today is to peel back those layers.
So we're going beyond just the price tag.
Exactly. We're looking at the machinery behind accident and sickness plans. Specifically, the criteria a group sponsor, like your employer, uses when they decide to shop around for a new insurance carrier.
Okay, let's start there. If a company is already paying for a plan, why look for a new one? What makes them start shopping?
The sources point to three main triggers. The first one, and it's always the biggest, is price.
Sticker shock.
Pure sticker shock. They get a huge renewal rate increase, and they can't absorb it.
That's relatable. What's the second driver?
A need for more benefits or, more flexibility. Maybe the dental plan is a decade old and people are asking for better coverage.
Or the competition is offering something they don't have.
Exactly. They need to stay competitive. And the third factor, well, that's service.
The quality.
It is. Dissatisfaction with the current carrier. Things like administrative nightmares for HR, slow claims for employees, or, and this is a big one, a high percentage of claims being denied.
Because if nobody can actually use the benefit, what's the point?
Precisely. The whole thing loses its value. So when an agent comes in, they have to do a full audit, figure out what's working, what isn't, and what the real cost drivers are.
Okay, so let's jump into that initial evaluation. You mentioned 3 pillars.
Right. The first pillar is a deep dive into the plan design.
And that's more than just a checklist, I assume.
Oh, much more. It's not just, yes, we have vision care. It's about the nature and scope. We're digging into the specifics. What conditions are covered? What are the benefit limits? Is it $500 for physio or $5,000?
And the definitions. That's where the devil is, right? In the detail.
Absolutely. The definitions, the deductibles, the co-insurance, that's where the real value or lack of it is hiding.
Which brings us to the second pillar, which I think you said was claims experience.
It is. Now, on the surface, this seems simple. High claims last year means high premiums next year. But here's where it gets really interesting.
Go on.
The source material points out a major paradox. A group with super high claims shouldn't just blame the employees for being sick.
Okay. So what should they blame?
You have to ask why the claims are so high. It might not be the people. The design of the plan itself might be, actively encouraging a high level of claims.
Wow. So by trying to be generous, a company could be shooting itself in the foot financially.
That's the paradox. A plan with very broad coverage, really liberal definitions, or super high benefit maximums. It basically removes any reason for a member to think about cost.
So how do you fix that without just gutting the benefits?
You introduce a little friction, things that make the member think twice.
Like deductibles.
Deductibles, co-insurance where the member pays a percentage, waiting periods, even proactive things like an employee assistance plan, an EAP, can help solve problems before they become expensive medical claims.
That makes sense. Address the root cause. And the third pillar.
The third one is simpler but just as vital, satisfaction with the current provider, the admin side of things.
Right. If your HR team is spending hours correcting billing errors, no premium saving is worth that headache.
Exactly. Service matters.
Okay, so once that audit is done, you start looking at new proposals, and the big warning here is don't just jump at the lowest price.
It's the classic mistake. A lower price often just hides deficiencies.
Yeah.
You need a really rigorous side-by-side comparison to see if you're getting actual value.
The same benefit is almost never actually the same. It's just similar.
You've got it. That's the trap.
But let's talk about that comparison. For something as critical as long-term disability, what are the must-check details?
First and foremost, you have to check the definition of disability.
Own occupation versus any occupation.
A world of difference. Can you not do your specific job, or can you not do any job? You also check the waiting period before benefits start. And critically, you look for those ancillary services.
Like rehab programs.
Exactly. Rehabilitation, retraining. Those things add immense value. They're designed to get you back to work.
What about drug benefits? Costs, they're always ballooning.
For drugs, you're checking the usual suspects, deductibles, co-insurance. But the big one is the formulary. Is it open or restrictive? And does it cover brand name drugs, or is it generic only?
That's a huge cost driver.
It is. And for something like critical illness, where you get a lump sum, Again, it's all about the definitions.
You check the payout amount, obviously, but
But you have to scrutinize the definitions of covered conditions. One insurer might define a heart attack differently than another to make sure the new definition is at least as good as the old one.
so this whole process is critical. Once the design is mapped out, we get to the money itself, the funding structures.
Right. And this all comes down to how much risk the sponsor, the employer, wants to take on themselves.
Let's start with the most common one for smaller businesses: non-refund accounting.
This is your traditional, fully insured plan. The insurance company takes on all the financial risk.
So if claims are way higher than expected,
It's the insurer's problem. The sponsor has zero liability for that excess cost.
sounds like a pretty good deal. What's the catch?
The catch is what happens if claims are lower than expected. If the group has a really healthy year,
Let me guess. The sponsor doesn't get any money back.
not a dime. The insurer gets a windfall. There's no refund. That's why it's a guaranteed premium. It's guaranteed for both sides.
Okay, so you're paying for security, but you give up any potential upside. What's the middle ground?
That would be refund accounting, or sometimes it's called retention accounting. It's kind of a participating model.
Meaning the employer gets to
Different.
participate?
Yes. If the group's claims experience is better than planned, the employer actually gets a partial refund of the premiums they paid.
But if it's worse,
Then the insurer recoups their losses at the next renewal. It's a shared risk, shared reward system.
and what if a company is absolutely enormous? Can they just bypass insurance altogether?
They can. That's the third model. Administrative services only, or ASO.
So what does ASO mean in practice?
It means the insurance element is gone. The sponsor, the employer, assumes all the risk of paying claims.
All of it.
All of it. The insurance company just provides the administrative services processing claims, keeping records for a fee. If there's a $10,000 drug claim, that money comes straight from the employer's bank account.
Wow. So you'd need massive cash flow for that.
Massive. We're talking thousands of employees. You're
What?
basically acting as your own insurance company.
Okay. That risk structure makes sense. Now let's talk about who actually pays the premium. Employer, employee, or a mix. This sounds simple, but you said it has some hidden tax implications.
This is the hidden tax trap, and it's something every employee should understand, especially for long-term disability.
First, the structures.
Simple enough. Non-contributory means the employer pays 100%. Contributory means the cost is shared or the members pay it all.
And when it's shared, participation is usually optional.
Usually. But there's a minimum percentage that has to join, so the risk pool is balanced. You don't want only the sickest people signing up.
Right. Now for the tax trap, let's focus on long-term disability, LTD. This is critical.
It's huge, and the tax outcome depends entirely on who paid the premium.
Okay, lay out the two main scenarios for me.
Scenario 1. The employer pays 100% of the LTD premium. If you go on claim, the disability benefits you receive are fully taxable income.
Ouch. So you're already dealing with a health crisis, your income drops, and then the government takes a huge chunk of your benefit payment.
It could be a devastating surprise. Now, scenario 2 is the opposite. If the employee pays 100% of that LTD premium.
They don't get a tax deduction for it while they're working.
Correct. But if they go on claim, the benefits they receive are completely tax-free.
Which, for most people, is a much better outcome.
A much better outcome.
What about a 50-50 split? The source material had an example, right, Shauna?
It did. Both she and her employer had paid in $3,600 each over the years. When she went on claim and received $9,600 in benefits.
How is that taxed?
Her first $3,600 of benefits, the amount equal to what she had paid in, was tax-free.
Got it.
But the remaining $6,000 was treated as taxable income. The moment her own contributions were used up, the tax hammer fell.
That's really complicated.
It is. And that's exactly why many smart contributory plans are designed so that the employee's portion of the premium is allocated first to the LTD benefit.
Ah, so you isolate it.
You isolate it. Even if it's just $10 a month that the employee pays, if it's earmarked for LTD, the entire benefit becomes tax-free. It's a critical design choice.
So important. Before we hit the final section on rates, any other fixed costs to know about?
Just a couple of quick ones. Every plan has a group premium tax. It's a provincial tax, usually 2 to 3.5%, and it's just baked right into the premium. You never see it as a separate line item.
Just part of the cost of doing business.
It is. And on the flip side, there's a potential cost reduction for employers related to employment insurance.
Oh.
If you have a short-term disability plan that's as good or better than the government's EI sickness benefit, you can register it with the government.
And why would you do that?
because your plan becomes the first payer, taking the load off the EI system. In return, the employer gets a partial reduction in their EI premiums, a tangible cost saving.
Makes sense. Okay, let's get to the final piece of the puzzle. How are the rates actually calculated? This is where that concept of credibility comes in.
Right. We know things like age, gender, and industry affect the rates, but the calculation method itself depends on the group's claims history.
Let's start with a brand new company. No history at all.
That's called manual rating or pooled pricing. The insurer has no data on you, so they base your rates on a huge pool of similar groups. Same industry, same size.
They're betting you'll perform like the average.
Essentially, yes. Now, at the other extreme, you have a massive, stable group that's been around for decades.
They'd be experience rated.
Exactly. Their rates are based almost entirely on their own past claims because their history is seen as a very reliable predictor of their future.
And most companies are somewhere in the middle.
The vast majority. And that's where we get blended rating. It's a mix of the manual rate and the experience rate. And the ratio of that mix is determined by credibility.
Credibility meaning how much the insurer trusts your past data.
That's a perfect way to put it. A large, stable group has high credibility. Their own experience matters more. A small group with high turnover has low credibility.
And if you have low credibility, what does that mean for your rates?
It means your rates are based more heavily on that standard pooled manual rate. The insurer relies more on the average because your own history is too volatile.
The sources gave a really specific example for this, the Master Mobile Company.
They did. A medium-sized firm, 37 employees, 4 years of history, and a pretty high turnover rate.
So, low credibility.
Relatively low, yes. They were rated at only 40% credibility.
And what does that 40% number actually mean?
It means their renewal premiums were calculated as a blend. 40% based on their own claims history, and the other 60% based on the standard manual rate for a group like theirs.
Well, they were still mostly swimming in the general pool.
Very much so. To get to 100% credibility, where it's all based on you, you often need hundreds, even thousands of employees.
This has been, wow. It's clear that navigating group benefits means looking so much deeper than just the price.
You have to. The definitions, the funding model, the tax implications on LTD, it's all connected.
It allows a sponsor to build a plan that's not just cheap, but actually provides real security.
That's cool.
So as a final thought, let's circle back to that paradox we talked about earlier, that a plan's design can actually encourage claims.
Right, the idea that adding deductibles or coinsurance creates a moment of deliberation, some skin in the game.
Because if a benefit is seen as completely free with no out-of-pocket cost, people are just more likely to use it.
It's human nature.
So the next time you, the listener, think about getting new glasses or visiting the physio, just because your benefits reset on January 1st and it feels free, remember what we talked about today.
You're not just claiming a service. You're contributing to the aggregate claims experience of your entire group.
And that behavior, multiplied across everyone in the company, directly drives up future premiums for you and all of your colleagues. It turns out we are all stewards of our own benefits plan.
An excellent thought to end on. Thanks for joining us for this deep dive.
We'll catch you next time.